Well, this is crazy. We just had a major paradigm shift in the world of investing because for the first time in 100 years, we just broke a key rule of investing called the 60-40 principle. Now, if you're new to investing and you're not sure what that is, when our parents first learned how to invest, for example, they didn't have YouTube as a resource. Back then, all they had was books. And one of the first things they learned about was something called the 60-40 principle. And all it is a strategy that says if you had $100, for example, you would invest $60 of that money towards something like the stock market, which is a stock like VOO, for example. It's an ETF, one stock that represents the top 500 companies in the US. Now, the other 40%, or $40 in this case, would go towards something safer, like treasury bonds or fixed income assets, or something like money market funds, which are considered very, very safe. Now, both bonds and stocks this year are down. Now, the reason this strategy is considered broken right now is because bonds and stocks are supposed to move in the opposite direction of each other. So historically speaking, when the market goes up, the bond market goes down. And when bond prices go up, the stock market goes down. It's a way to balance out your portfolio, and data shows that over the long term, this gives you a smoother ride while giving you less heart attacks than a portfolio that invests 100% of its money into the stock market. But this year, everything changed because the 60-40 portfolio just had the worst year in 100 years because it's now down over 30%, which means no matter what you put your money into, whether it's stocks or bonds, you've probably lost money this year. Now, if you're saying to yourself, Andre, I don't care about any of this. I don't invest in bonds or the 60-40 portfolio, but you should care because chances are if you invest through a 401k at your job, you have some exposure to the bond market and this strategy. And it's important to understand exactly what's going on, why this is happening, and how long this will last. So with that said, let me explain exactly what's going on. Let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Cover the finance and stay for the fun facts because believe it or not, stocks and bonds both going down this year for the first 3 quarters in a row is so unheard of that it has never happened before in the history of investing. Now, this is going to blow your mind because there's a website called portfoliovisualizer.com, and what it does is it lets you back test data to see how much money you would have made investing throughout different time periods building your own custom portfolio. It's super cool. And it's also 100% free to use, so go check it out. But what we're gonna do is we're gonna build 2 portfolios. One that's 100% stocks, and another that's the 60-40 portfolio to see which one does better. So I used to think that the 60-40 portfolio would make me roughly half of the amount of money that a pure 100% stock strategy would make, because it makes sense. Roughly half of my money, 60%, is invested in stocks, and the other 40% is invested into super safe assets like bonds, which I used to think aren't going to make much money. But that's not always the case. Check this out. You can see how throughout most of history, going back as far as 1972, the 60-40 portfolio, which is this red line, and the 100% stock portfolio, which is the blue line, are actually really close. In fact, almost identical performances in some years. And that's why the 60-40 is so important. Because even though the 60-40 portfolio makes less of a total return, the one advantage it has over purely stocks is that during the worst years of investing, it has also historically lost less money, which is a lot easier to stick to rather than 100% stocks when you're down almost 40% in some years and you're freaking out and you're almost selling everything. That's why the word correlation is so important to investors right now, because correlation is the measure of how much 2 things are connected. It's measured from 0 to 1, and the goal with investing is to diversify enough so that your portfolio has a correlation of 0 or negative. If you invested in a watch, for example, that you thought would do well, like this Rolex, but you also bought another watch that you thought would do well, like this God-tier red G-Shock to diversify, the correlation between these 2 watches is technically close to 1, because even though they are 2 very different watches, they both belong to the same asset class. So whatever happens to the watch world, both of them will be affected at the same time to different degrees, which is why the standard advice has always been to buy not just stocks, buy some bonds, some real estate, some crypto, maybe gold, some art, some alternatives. That way you can smooth out your ride and not give yourself a heart attack on the roller coaster of 100% stocks. And for the longest time, this advice worked because data shows that the correlation between stocks and bonds has been 0 or even negative. And that's a good thing because investors have relied on this 60-40 strategy to get them through tough times. Until now, which is a big problem. Here's a chart, for example, that proves just how close stocks and bonds are. The dark blue graph represents the last 10 years of correlation, which is negative, and the light blue graph shows that correlation is very close to 1, which means this year, diversification is pointless. And that's because everything is moving in the same direction, which is obviously down. So now the game begins. Let's play Who Wants to Be a Millionaire? Your $1 million question is, why are stocks and bonds now moving in the same direction? Is it A, because interest rates are going up, B, because of high inflation, C, because Joe Biden did it, or D, the Illuminati? Pause the video to smash the like button to lock in your answer, and now let's use a lifeline to remove 2 of the wrong answers. I'm just kidding. Those are not the right answers. The right answer will be revealed right after a quick word from today's sponsor. All right, with the soul-crushing reality of the market, every day seems a bit darker, but there's hope with Masterwork. Masterworks, all right, I've been getting a ton of questions about Masterworks because I've been telling you all year how great of an opportunity this could be. And the most common question I get is, are people actually doing this? And yes, 100%, there are hundreds of thousands of people that have started investing in art, and my community alone has invested millions. And if you're someone who hasn't invested because you have questions, let me give you the details. And number 1, how does it work? Masterworks lets you invest into multi-million-dollar works of art from artists like Picasso, Basquiat, and Banksy. These are not NFTs. Then their team of world-class analysts will use proprietary data compiled from millions of auction records to source art with the greatest potential appreciation. Then they divide the art into shares so you can invest without needing millions of dollars. They then wait to sell at the opportune moment to give you the best results, like an exit for a net return of 21.5% to their investors 3 weeks ago at the start of October. Question 2, is Masterworks legit? Yes, they have an A+ rating with the Better Business Bureau, and this is one of the 150 plus offering circulars Masterworks filed with the Securities and Exchange Commission, one for each painting in their collection. You can read them all on their website at masterworks.art/Andrei Jikh or at the Edgar database at sec.gov. Question 3, is art a bubble? This is Morgan Stanley's report on the art market, and when you read that the average piece is selling for 26% more at auction than it did last year, sounds like it's too good to be true, but Morgan Stanley disagrees because their research shows that auction numbers trend upward very gradually from last year without a crazy spike in 2022, just a beautiful V-shaped recovery. And that's why there's so much huge potential for the art market. In fact, last year in October, Masterworks raised $110 million for their first fundraising round, which makes them a startup unicorn valued at over $1 billion. Now, Masterworks has sold 7 paintings to date, including the most recent one I mentioned. And that painting they just sold since my video on them last month for an incredible 21.5% net return, which means if you had put in 15K, you'd walk away with over 18K. So if you want to learn more info beyond just me talking, sign up using my link down below, where you'll be invited to join Masterworks weekly webinars where they do market reviews and live Q&As, because having questions is a good thing, and it's why I make my videos in the first place. So go check them out using this link down below, and now let's get back to it. All right, so back to the question. Why are bonds and stocks moving in the same direction? The answer is B, because of high inflation. Congratulations if you got the right answer. You are now a millionaire in the metaverse. But you have to remember that inflation is sort of like the cancer of the finance world. Inflation is giving all of these different assets a positive correlation, meaning they're all moving in the same direction, which right now is down. Right now, no one is winning when there's high inflation, except for maybe greedy corporations, which are making record profits, and they're blaming inflation on increasing prices, but that's a separate video. The point is, high inflation means no one is winning. Not stocks, not bonds, not even crypto that we've learned this year. But the mechanics of how this works is really interesting. I'm gonna explain it, but I'm gonna put you to sleep, so if you make it through to the end, you're amazing. So here's how this works. When the stock market falls as a whole, it's usually because there's less demand from consumers. When we buy less stuff, companies make less money. When companies make less money, their earnings fall, therefore their share prices fall. And when there's less demand, companies lower the price of their stuff. When they do that, there's less inflation. When there's less inflation, the Fed thinks it's a boring party. And the Fed loves to party. It doesn't want to party too much, but not too little either. So to spur the party, they lower interest rates. And by lowering interest rates, it encourages people to borrow and spend more money. And when they lower interest rates, the new bonds that get created at their newer low interest rate. And that's a really good thing for bond prices, because bond prices and rates are inversely correlated. It's completely counterintuitive. Like, why wouldn't bonds have a higher rate but also be more pricey because I want juicier rates? It's weird, but if you really want to know, it's because when the Fed creates those new bonds at lower rates, the people with those older bonds, which have the higher rates, can sell them on the open market for a higher price because they're juicier and more appealing. That's why when the stock market falls, typically speaking, bond prices go up. And that's how it's supposed to work, but right now all bets are off, because even though there's high demand and even though corporate margins are at record highs, the stock market is falling. And the reason the stock market is falling is because there's a million reasons, but mostly, and the easiest one to understand, is because there's so much uncertainty. So many crazy things are going on around the world that the stock market can't predict. And because corporations are using inflation as a scapegoat to charge us, the consumer, higher and higher prices, is why inflation keeps going up and up. And when inflation is going up and it's overheating, the Fed's like, yo, the music's too loud, let's cool this party down. And the way they take the party down is by increasing rates. And when they increase the federal funds rate on us, they create new bonds with those higher, juicier rates, which means the people which are holding those older bonds with their lower rates that are less juicy, when they go to sell their older bonds, they have to lower prices to compensate because we're getting the new bonds at those higher rates. That's how this inverse relationship works. It's super confusing. The point is, both stocks and bonds are going down right now, which is why the 60-40 portfolio is broken. Now, unfortunately, the cost of fixing this high inflation is going to be that people will have to lose a lot of jobs. It's estimated as many as 1 to 2.6 million jobs will disappear next year at the rate of roughly 175,000 jobs per month in the first quarter of 2023, which is obviously really bad. So the ultimate question is, will things ever go back to normal, and will the 60-40 portfolio ever work again? The answer is, I have no idea. Things will probably go back to working the way they're supposed to, which is where bonds and stocks are inversely correlated, but for now, no one has any idea when that's gonna happen. Most likely when inflation goes away, but no one knows how long inflation will last. Will it last for a year or for 10 years like it did something in the 70s? Either way, for now, nobody knows, which is why everything we're putting money into, inflation is acting like a force of gravity that's dragging everything down, and why everyone is losing money no matter what they're doing. The only real asset that's guaranteed to make money and match inflation is I-bonds. They're the only things that are guaranteeing that kind of a return, but the downside is there's a $10,000 yearly contribution limit. Now, since I'm not ready to retire yet, I'm not really investing into bonds, and I'm gonna keep going with my strategy, which for now is 100% into stocks, but maybe as I get older, that will change with time. Either way, if you're not sure, definitely use portfoliovisualizer.com. It's a really cool tool to see how well your investments would do throughout different periods of time. As always, I'd love to hear your thoughts. Have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here, move it offline, get your free stocks. Links are all down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon. Bye-bye.